I believe the time has come to lower the target range for the federal funds rate at our upcoming meeting. Reducing the policy rate now is consistent, for example, with many versions of what are called the Taylor rule, which suggests reducing the policy rate is appropriate given the data in hand. Furthermore, I do not expect this first cut to be the last. With inflation and employment near our longer-run goals and the labor market moderating, it is likely that a series of reductions will be appropriate. I believe there is sufficient room to cut the policy rate and still remain somewhat restrictive to ensure inflation continues towards our 2% target. Now, determining the appropriate pace at which to reduce policy restrictiveness will be challenging. Choosing a slower pace of rate cuts gives time to gradually assess whether the neutral policy rate has in fact risen, which a lot of people have been discussing. But we do so at the risk of moving too slowly and putting the labor market at risk. Cutting the policy rate at a faster pace means a greater likelihood of achieving a soft landing, but at the risk of overshooting on rate cuts if the neutral rate has in fact risen above its pre-pandemic level. This would cause an undesired loosening of monetary policy. Determining the pace of rate cuts and ultimately the total reduction in the policy rate are decisions that lie in the future. They are not going to be decided today. But as of today, I believe it is important to start the rate cutting process at our next meeting. If subsequent data show a significant deterioration, not softening, but deterioration in the labor market, the FOMC can act quickly and forcefully to adjust monetary policy. I am open-minded about the size and pace of cuts, which will be based on what the data tell us about the evolution of the economy, and not on any preconceived notion of how and when the committee should act. If the data supports cuts at consecutive meetings, then I believe it will be appropriate to do so.